What is happening to Shopify as shares of the e-commerce giant are down 19% after the company reported their Q1 numbers? We'll get into some things, not just the Q1 numbers. We'll also take a look at the Q2 guidance, see how that compares with expectations. Do we have to start re-rating this stock for future quarters as well? Is the outlook not as bright? Then we'll come over here and look at this financially as well. We looked at a company yesterday, almost identical to Shopify, almost identical business model. We looked at Toast. They were on the turning point of profitability. Well, certainly Shopify has been there, but the difference is with Shopify, you've got a $99 billion valuation. I'm seeing over here on TradingView, you got $80 billion. Whether it's 80 or 99, that is a gigantic valuation. We'll come over here and try to make sense of that. We'll look at the balance sheet. We'll also look at cash flows. And then we'll look at this technically. If you're in this stock and you're kind of concerned, there are a couple levels that we're certainly monitoring here. And despite shares being off 19%, potentially, not all hope is lost. Now, over the last year, you're down about 3% on this one. Year to date, now down 20%. You stretch this out to a 5-year period. That's where your return is, up over 141%. But very similar, we did a video earlier this week on Palantir. Shopify and Palantir, while completely different companies from a business model perspective, very similar from a market cap perspective. These companies with these big market caps, they have to knock it out of the park. And if you don't, you can see what happens to shares. Revenue came in at $1.86 billion. That was 23.2% growth. It beat expectations by about 10 million. But again, for a stock with a huge valuation, that's usually not good enough. The high-end estimate was closer to $1.91 billion. So they were off of that. Also, we got Q2 guidance as well. Company saying revenue as a percentage of growth is going to be in the high teens percentage rate. So what does that mean? Well, Wall Street has the company pegged at a 19.73% growth rate. Some analysts up closer to 20%. And so is high teens. Is 16? Is it 17? Is it 18? Or is it 19? That's tough to say. We also have to bring into question, obviously, as we move through the year, you get into back to school season. You also get into a holiday shopping season. You'd expect Q3 and Q4 to be strong, but will they be as strong as expectations have them in the low 20% growth rate? Because when we come over here and look at this financials, the company still has a long ways to grow into this valuation. Revenues went from $1.5 billion up to close to $1.9 billion. Your cost of that revenue coming in at $904 million in the most recent quarter. So you had gross profits at $957. Now you come down to all important operating expenses. I noticed in the quarter, sales and marketing ticked up in excess of our sales growth. And obviously this company has a recurring business model. And so it's not a big deal to maybe kind of front load some sales expenses and you make it back after year 2, year 3 of the customer being with you. General administrative fees went down, roughly flat year over year. It was your research and development that ticked down year over year. So your total operating expenses year over year, despite an increase in sales and marketing, it was offset by a reduction in R&D. So your total operating expenses went from $910 down to $871. So you swung positive from an operating profit perspective. Last year, you lost $193 million off of $1.5 billion in revenue. This year, you've turned the corner off of $1.9 billion in revenue. You made $86 million. Now, $86 million to you and I tell you what, we having a great time. To a company that is worth in excess of $90 billion to print just $86 million to the operating statement, obviously, they have a long ways to go, and this is what has some investors concerned. With the growth rate slipping back into the 20% range, how long is it going to take for this company to grow into this elevated valuation? People are asking the same questions right now about Palantir, about Super Microcomputer. That's why you got to be a little careful. It's not that you can't invest in these companies. These are great companies to invest in, but you got to be a little careful on them when the growth rate just doesn't match up to the valuation. You can see what happens to the shares of the company. Now, nothing to worry about from a cash balance sheet perspective. Total liabilities is less than what they have in cash. So this company has a long runway, nothing to worry about financially. And in fact, I don't think this company is probably even have to do any kind of fundraising, equity raise, long-term debt, anything like that. Doesn't look like that to me. In fact, I'd be surprised if they went that route unless they had some kind of acquisition in mind. Now, from a cash flow perspective, it's beautiful. Last year, you made $100 million in positive cash flow. This year, more than doubled to $238 million. Again, this is for 3 months ended. But again, you have to start annualizing this number out. Times it by 4, give them credit for a little higher in the fourth quarter since they'll probably have higher revenue. Well, you're not even at $1 billion of operating cash flow for a full year on a company that's worth $80 to $90 billion. Now, they don't have a lot of uses for this cash. It's just going to benefit this company. That is one of the reasons why you have the high valuation. If you can continue to grow these revenues, these operating cash flows are going to explode, and you're unlike some of these companies that have to invest it in property, plant, and equipment and other types of things. This cash is going to flow all the way to the bottom line, and this is just going to become a cash flow generating machine. That is the thesis around Shopify. Now, technically, yes, we've had a very, very major drop, but this stock has had a beautiful rally off the October lows, making a series of higher highs, higher lows. Right now, we are testing that level right now. You are seeing some buyers step in at this level. Wouldn't say that the level that we're at is absolute line in the sand. I would say it's a little bit further down here at $54 per share. That has served as an area of both support and resistance in the past. You would not want to see Shopify get down below 54. You get down below 54, you're going to retest these lows at 46. You retest the lows at 46. You could retrace and retest all the way back down here at a support level south of 30. And I know that seems crazy. Stock goes from 60 all the way down to 30, but you'd still have a $40 billion valuation on this one that's printing about $1 billion of operating cash flow for a full year. Still, believe it or not, very richly valued. And so I think the lesson of the day is it's not a big deal to be invested in the Shopifys, the Palantirs, the super micro computers, but you just have to understand that the companies have to deliver so well on their earnings results. And when it just meets expectations, and certainly if it comes underneath them, you can have some violent results to the downside. This is why it's important to take profits on these stocks when they do run. You don't necessarily have to sell your full position, but take profits on the way up and certainly learn how to get out of these stocks on the way back down, because like Shopify and maybe some of these other ones, it could continue to get worse before it gets better. Hopefully you guys enjoyed today's video. We'll be back again with more. Good luck with your investments.